Political decisions don't just shape governments, they directly impact our financial lives. From rising costs of living to shifts in investment opportunities, it's essential to understand how these policies affect your wallet. More importantly, you need actionable strategies to protect your finances in uncertain times. In this video, we'll dive into 7 major developments and provide specific steps you can take to safeguard your money. The Trump administration's proposed shifts in defense strategy could lead to significantly increased military spending. While defense funding often brings growth to industries like aerospace and manufacturing, it typically comes at a cost. To finance increased spending, the government might reduce funding for domestic programs such as education, infrastructure, or healthcare. This could limit the availability or quality of services that many Americans rely on, shifting more financial responsibility onto individuals. Another potential consequence is the rising national debt. If defense spending outpaces revenue, the government may resort to borrowing more, increasing the federal debt. Over time, this can lead to higher taxes or inflation, both of which reduce the purchasing power of the average American. Additionally, a focus on military spending could crowd out investments in sectors that drive broader economic growth, such as renewable energy or technology. For individuals, this situation underscores the importance of budgeting carefully. Start by diversifying your investments to avoid overexposure to defense-related industries or volatile markets. Consider reallocating some funds into bonds or dividend-paying stocks that offer stability. Stay informed about changes to tax policies, and plan ahead by trimming unnecessary expenses in your budget to prepare for potential increases in tax burdens. The ideological diversity within Trump's cabinet has the potential to create both opportunities and risks for Americans' finances. Deregulation in certain industries could boost profits and lead to stock market growth, but it may also increase risks like speculative bubbles or weaken consumer protections. For instance, fewer regulations on financial institutions could make borrowing easier, but also increase the likelihood of another financial crisis. Changes to tax laws are another area of concern. While some Americans may benefit from lower taxes, others might face higher rates depending on how policies are structured. Similarly, shifts in healthcare regulations could raise medical costs for some households, directly impacting budgets. Inconsistent policy goals within the cabinet may also lead to market uncertainty, making it harder for individuals to plan their investments and savings. To navigate these challenges, it's crucial to stay proactive. Keep track of potential tax policy changes and adjust your savings strategy accordingly. Consider consulting a tax professional to ensure you're taking advantage of all available deductions. Review your healthcare coverage to confirm you're enrolled in the most cost-effective plan, and keep an eye on industries likely to benefit from deregulation, but don't overcommit to speculative sectors. Immigration policy directly impacts the agriculture sector, which relies heavily on immigrant labor. Stricter deportation policies could reduce the available workforce, increasing production costs for farms. As a result, Americans may face higher grocery bills as farmers pass those costs on to consumers. Beyond agriculture, industries like construction and hospitality may also see rising costs, affecting everything from housing prices to restaurant services. The economic ripple effect of these policies can strain household budgets, particularly for lower-income families already struggling to make ends meet. Rising food prices in particular hit families where it hurts most. Necessities like produce, dairy, and meat become increasingly unaffordable. Additionally, higher labor costs in construction could make homeownership even more difficult to achieve. To protect your wallet, focus on cost-saving strategies for essentials. Shop for groceries in bulk, or seek out local farmers markets where prices may be more stable. You can also consider starting a small vegetable garden to supplement your food supply. For other goods and services, look for budget-friendly alternatives or discounts to minimize the financial impact of rising costs. The Treasury's actions to calm the bond market have led to a significant rally in the Dow, boosting investor confidence and driving record-high stock market gains. While this is great news for those with investments in retirement accounts or mutual funds, such rapid growth can also signal potential instability. Markets often correct themselves after periods of strong performance, leaving unprepared investors vulnerable to losses. For everyday Americans, these market dynamics mean that retirement savings and other investments may experience short-term gains but also heightened risks of sudden downturns. Additionally, rising markets can make entry points for new investments more expensive, discouraging smaller investors from participating in market growth. Inflation linked to these changes may also reduce the value of returns over time. To protect yourself, rebalance your portfolio regularly. Use the current market gains to allocate funds into safer investments like bonds or broad-based index funds. Avoid making emotional decisions based on short-term trends and stick to your long-term investment strategy. Lastly, ensure you have a robust emergency fund with 3 to 6 months of living expenses to provide a financial cushion during unexpected market shifts. Inflation has been rising, directly reducing Americans' purchasing power. Essentials like groceries, gas, and housing become more expensive, making it harder for families to manage their budgets. The Federal Reserve's response, raising interest rates, has made borrowing more costly, increasing payments on mortgages, car loans, and credit card balances. These changes put a squeeze on households with existing debt, or those looking to make major purchases. Higher interest rates also discourage spending, slowing economic growth in the long term. For individuals without fixed-rate loans, rising rates can mean skyrocketing monthly payments, leaving less money for savings or discretionary spending. To mitigate these effects, consider refinancing variable-rate loans into fixed-rate options while rates are still manageable. Focus on paying off high-interest debt quickly, such as credit card balances, to reduce overall financial strain. Finally, review your budget to cut unnecessary spending and redirect those funds into savings or debt repayment. Gold prices recently dropped due to changes in Treasury policies, illustrating the volatility of commodity markets. While gold is often seen as a safe haven during economic uncertainty, its value fluctuates based on factors like inflation, global tensions, and shifts in government policies. Short-term losses can catch investors off guard, reducing the overall stability of their portfolios. For individuals considering gold as part of their investment strategy, this volatility underscores the need for caution. Relying too heavily on any one asset class, especially commodities, can expose you to unnecessary risks. Moreover, as other investment options like technology stocks or real estate gain traction, gold's relative importance as a hedge may diminish. To manage these risks, diversify your investments across multiple asset classes, including stocks, bonds, and real estate. Keep an eye on economic indicators like inflation and geopolitical events to assess whether gold aligns with your financial goals. Most importantly, avoid panic selling during market dips. Gold often recovers its value over the long term. Emerging technologies like AI and cryptocurrencies are reshaping the investment landscape, with ETFs focused on these sectors seeing significant gains. However, these investments come with high risks due to their volatility and speculative nature. Sharp fluctuations in value can lead to substantial losses, especially for those who invest without fully understanding the underlying technology. For Americans looking to participate in these growing markets, it's crucial to approach with caution. Cryptocurrencies, for example, are highly unpredictable and subject to sudden regulatory changes that can dramatically affect their value. AI-focused ETFs may offer broader stability, but still carry risks tied to the performance of specific industries or companies. To navigate these opportunities, allocate only a small portion of your portfolio to speculative investments like AI-focused ETFs or cryptocurrencies. Research the technology and industries behind these assets before committing funds. Finally, diversify your exposure by including a range of innovative industries in your portfolio, rather than concentrating on one. The world of politics and economics is more connected to your wallet than you might think. From inflation and taxes to market volatility, these developments require proactive planning and informed decision-making. By staying updated on policy changes and applying the specific strategies we've discussed, you can protect and grow your finances, no matter what challenges arise. If you found this video helpful, don't forget to like, subscribe, and comment below with your thoughts or questions.